Dovish Fed drives the dollar down across the board. It was all about the Federal Reserve meeting these days. As was widely expected, the central bank held interest rates unchanged, expressed increasing concern about slowing economic growth on Wednesday, and showed little appetite for raising them in the near future. The Fed said in a post-meeting statement that, quote, growth of economic activity has slowed from its solid rate in the fourth quarter, end quote. It cited slowdowns in household spending and business fixed investment and said it expects economic growth of 2.1% for 2019, which is down from 2.3% that it forecasted in December. The bank also revised down its expectations for headline inflation, which includes volatile commodities like oil and food, to 1.8% for the year, and in December, the forecast was 1.9%. During his press conference, Powell noted that they continue to expect economy growth at a solid pace. Average monthly jobs growth appears to have stepped down from last year. Retail sales data shows slower pace, as well as business fixed investment, and it may be some time before the economy calls for a change in policy. The US dollar sank following the central bank's decision. Traders expected Powell to be a bit more upbeat on the domestic economy in comparison to foreign economies, but the Fed's governor sounded concerned about the current outlook. The FOMC's more dovish statement and dot plot, with no hikes this year and one in 2020, has pushed the greenback lower, stocks higher, and yields lower. The greenback was lower versus all the major currencies, with the exception of the Great British Pound. The euro-US dollar pair was hovering around 1.1350 before the release of the FOMC statement, and then jumped to early February highs just below the 1.450 level. As the current bullish impetus is purely due to the dollar weakness, the rally may be unsustainable. The common currency may take a pause as soon as traders digest the dovish message from the Fed. The GBP USD was also pushed higher after the FOMC meeting, but lingering Brexit uncertainty limited the gains. Earlier the day, the pair met with some fresh supply during and even broke down some of its early consolidation phase in reaction to the news that Labour lawmaker Alistair McGovern is tabling an emergency debate which will allow the UK Parliament to take control of the Brexit extension length away from Prime Minister Theresa May. Meanwhile, the latest UK consumer inflation figures coming in to show that the headline CPI held steady at 0.5% and climbed more than expected by 1.9% YY pace in February, failed to provide any meaningful boost, as the same was largely offset by a slight disappointment from the core CPI reading. After the FOMC, the pair found some support above the 1.32, but failed to turn positive on the day despite the widespread dollar weakness. As for stocks, the U.S. market reversed losses after the Fed said no further hikes in 2019. The S&P 500 and the Nasdaq reversed earlier losses and gained ground as the Fed affirmed its dovish monetary policy stance. The Dow narrowed its losses but failed to turn green on the day. The risk sentiment was also supported by the reports that the U.S. President Donald Trump said on Wednesday a trade deal with Beijing was coming along nicely, with U.S. trade negotiators poised to head to China the next week for another round of talks. As a reminder, U.S. Trade Representative Robert Lighthizer and Treasury Secretary Steven Mnuchin will head to China next week for another round of trade talks. Crude oil prices jumped to fresh 4-month highs above the $68 figure, around the $68.30 area, a day after the API's estimate of another weekly crude oil inventory draw in a row sent Brent higher. The Energy Information Administration confirmed a large draw at 9.6 million barrels for the week to March 15th, the biggest decline since July, and gasoline prices fell by 4.6 million. Domestic crude production rose to 12.1 million barrels per day from 12 million barrels in the prior week. Earlier, prices stalled on reports that China is pushing back against U.S. negotiators during trade talks, raising fears that an eventual deal may take longer to hash out or just be watered down. But on Wednesday, the positive EIA report and a weaker dollar, coupled with some positive comments by Trump on the relations with China, boosted prices and helped Brent to break above the $68 handle. Gold prices jumped above the $1,315 region to the highest level since early March after the Federal Reserve decided not to raise interest rates and signaled the end of the balance sheet runoff by September. On the other hand, risk appetite in the global financial markets remains upbeat as there are no major geopolitical matters moving the world market at this stage. This has been a constraining factor for prices advances in the safe haven gold market. Positive signals in the U.S.-China trade front also dent the yellow metal's appeal as investors continue to hope that the two of the world's largest economies will finally strike a trade deal. And that is all for today. Thank you so much for watching. Please don't forget to click subscribe to always be in touch with the latest market news.